All right, everybody, welcome back for another deep dive. One of the big things we've been getting a lot of questions about lately is the state of the stock market, particularly all those crazy high PE ratios we're seeing, especially in the S&P 100.
Yeah, I've heard about that too.
Yeah, and I know a lot of you out there are wondering if this is another dot-com bubble in the making. So today, we're going to take a look at what's driving these high PE ratios and what they could mean for quality stocks. Because let's be real, those are the ones that most of you are interested in, right?
Absolutely.
So to set the stage a little bit, as of late December 2024, the S&P 500 is sitting at a trailing PE of 30.09. Now, that's significantly higher than the historical average, which hovers around 17.9. So we're going to break this down today and hopefully answer some of your biggest questions.
Yeah, I mean, the PE ratio itself, it's actually pretty straightforward. You're just looking at the price of a stock divided by its earnings per share. But then you start to look at things like the forward PE, and that's where things get a little more interesting.
Okay, so let's talk about that. What exactly is a forward PE and why should we even care?
Well, think of it this way. A forward PE is basically using projected future earnings instead of the past earnings. So it's really all about trying to figure out if a company is overvalued based on what they're expected to earn in the future.
I see. So it's kind of like a sneak peek into the potential future of the company.
Precisely. And, current predictions show the forward PE ratio for the S&P 100 dropping to about 24.09 by the end of 2025. But here's the catch. That's only if earnings increase significantly.
Got it. So there's a lot riding on those future earnings reports. But let's back up a second. What's making the market so optimistic right now? What's fueling these sky-high PE ratios in the first place?
Right. Well, we can't ignore the elephant in the room. The post-pandemic recovery has played a huge role. I mean, just look at the economic growth we've seen.
Yeah, it's been pretty remarkable.
And on top of that, you've got certain sectors like technology and consumer goods that are just booming right now. There's a ton of optimism surrounding those industries, and that definitely contributes to the higher valuations.
Okay, that makes sense. But then you've got these super low interest rates. Doesn't that just create a bubble that's bound to burst eventually?
That's a concern a lot of people have, and honestly, it's a valid one. When interest rates are low, bonds become less attractive, right?
Right.
So investors start looking elsewhere for those higher returns, and naturally, they turn to the stock market. But yeah, like you said, that influx of cash can inflate prices, pushing those PE ratios even higher. It definitely creates a certain level of risk. And if those growth expectations aren't met, yeah, we could see a correction.
A correction. So you're saying there's a chance things could take a tumble.
I mean, there's always a chance, right? It's the stock market. It's inherently unpredictable.
Fair enough. But what about those top-tier quality stocks in the S&P 100, the ones we all know and love?
Yeah, the blue chips.
Yeah, exactly. Is the outlook the same for them?
Well, those quality stocks, they're generally seen as a safer bet. They've got strong track records, solid fundamentals.
Right, the ones you can usually count on.
Exactly. But the thing is, even those blue chip companies can stumble. They're not immune to market shifts and corrections.
So no stock is truly safe, huh?
Well, safe is a strong word. It's all relative. But the point is, even the most reliable companies can disappoint if their earnings don't meet expectations. That's why diversification is so important. You don't want to put all your eggs in one basket, even if it seems like a really, really good basket.
I get it. Don't put all your faith in PE ratios alone. So what else should we be looking at?
There are tons of other metrics out there. Price-to-book ratios, for example, are really useful. You're comparing a company's market value to its book value, getting a better understanding of its assets.
I see.
And then there's cash flow analysis. That can give you a much clearer picture of a company's overall financial health. Are they actually generating cash? Are they managing their debt effectively?
Oh, okay. So it's like looking under the hood to see how the engine's running.
Exactly. Don't just rely on the shiny paint job. You got to make sure the car can actually drive.
Okay, so just to summarize, we're in this high PE environment right now, driven by post-pandemic optimism, crazy low interest rates, and all these high-growth sectors that everyone's excited about.
Right.
But we need to be cautious, right? Future earnings could make or break things. The economy could always shift.
Absolutely.
And maybe it's a good idea to brush up on our history. Remember what happened in the past when PE ratios got this high?
Yeah, history tends to repeat itself.
So as we wrap up this deep dive, I want to leave you with a question to think about. As you're planning your own investment strategy, what other factors should you consider?
Yeah, that's the big question, isn't it? Beyond just the PE ratios, beyond the historical trends, what else can you explore to navigate this crazy, complex market?
And remember, this is just the beginning, folks. Keep learning, stay curious, and as always, Happy investing.